Here's the latest trades on Monday, October 28th for the stock index portfolio. Adaptive moving average is long, 60-minute breakouts long, gap continuation 2019 is long, and tick count trend 2 ES 1 minute is short. So how do you trade half the contracts? How would you reduce the number of contracts? These are trading one emini S&P or one emini NASDAQ per strategy. And so the question is, how would you reduce your risk? And the answer is simple. We would trade micros instead. So if you wanted to cut your risk in half, you could trade 5 micros instead of one emini on each strategy. I'm going to show you the portfolio calculator next and what that would look like. So here's my portfolio calculator in Microsoft Excel. I've exported all the data. You see the daily P&L data has been exported, and take some time to set this up. And here is the calculator section. And so you see one contract of each strategy. I'm in the process of rebuilding and adding all the strategies back. But right now I have the ones in the stock index portfolio. So you see one contract of each strategy. What are the results? 30,000 max drawdown, average annual profit of 55,000, total profit of 670,000, a margin requirement of 67,000, and account size required 97,000. And so what could you do if you wanted to trade the micros? So if you trade the micros, one micro is 1/10 of a full contract, so it would be 0.1. And you could just copy and paste that all the way down. So I'm going to do that. I'm going to copy and paste this all the way down, copy, and I'm going to paste it all the way down. And you're going to see the updated calculations of trading one micro. And so the max drawdown, 3,000. The account size required, 9742, and here the average annual profit, 559102. So you can. One of the things about this is you can scale this, and so every 10K that you have added to this, you can add another micro until you get to an emini. So it depends on your starting capital where you are. If you have 10K, this is where you want to start. If you had 50K, you'd change this to 0.5, and I'll show you the results for that in a minute. But if you go down, you can see the average annual profits. And so those are not bad for a 10K account. And let's take a look at the equity curve. There's a drawdown curve. And so it's fairly easy to withstand these sorts of drawdowns for most people. If these drawdowns are still too big for you, I would consider trading less strategies and going from there, trading one micro on one strategy maybe to begin with, or any type of drawdown. If any type of drawdown bothers you, futures trading is not for you, because futures trading does have drawdowns. So that is one micro contract, which is 1/10. We use 0.1 because it's 1/10 the size of a mini contract. What if you wanted to trade 5 micros? This is what it would look like: 0.5, and it would just basically be a half of a. It'd be half of a full contract, a full emini contract. I copied the wrong thing, so copy, and I'm going to paste this down. And this is the portfolio calculator tool that I use. It quickly gives you the information. 48K required, $15,000 drawdown, average annual profit of 27,000, and you see the results there. Nice results, and you can see the equity curves, and so it could be a nice additional income. These are historical hypothetical results, and we've developed this portfolio at the end of June, and you see the results since that time. It had a down July, up August, September, and October so far. So these are strategies that we've used a long time. This particular combination of strategies is new. As some of the strategies are new, but many of the strategies are old. It's the combination of these strategies that is new since June. And so this is how you would do half a contract would be 0.5 in this box. What if you have a larger account? What would it take to trade, say, 10 of these, 10 emini contracts, not micros, but 10 emini? 10 micro contracts would be one emini, so you just put one there, and that's the first option that we looked at. But if you have significantly more capital, example, almost $1 million, and you can handle $304,000 drawdowns, that's a big drawdown on $1 million. Usually the more capital you have, you deleverage. But here is what it would look like. Some really big returns. But you have a fairly large risk, a 30% drawdown on $1 million. And so because this has that type of drawdown, if you have $1 million account, you may want to deleverage to so that there's only a $50,000 drawdown, 1/6 of this, maybe 2 or 3 emini contracts. Since it's $30,000 per emini contract, maybe you're comfortable with 2 or 3 contracts, $60,000 or $90,000 drawdown. And so this is a result though. If you're comfortable with the risk, you could also wait for a drawdown like it is in now, or slightly more. Right now, your risk would be $250,000 in worst case drawdown. And so this is what this would look like. 1.98 million last year. It's pretty big. It'd be a lot of volatility. 638,000 in 2017, 711,000 this year. And so there it is. The returns are these drawdowns go deep, but they tend to return quickly. They're V's. They're a little wider back here, and we're using strategies that don't work the entire time, and so we've included those to be unbiased in our approach. And so some of these strategies may have negative returns overall, but positive returns in the last several years. So this is an unbiased approach of a multi-year back to 2008 setup. What would this look like? And this is what you could anticipate. One of the best ways also is to just scale. Start with what you can handle risk-wise, and then as you have profits, you add to those.